Welcome, everybody, to the JSS Podcast. This is Byron Enriquez, a casual executive, your resident finance bro. It's been a couple weeks, so probably be a little rusty here, and we'll do our best to get some information out. Busy last couple of weeks for us. We were at an event. We sponsored a big event here in our community for some realtors. Just trying to get out there in our community, do our part. One of the things that I always talk about in sales is, making yourself visible, following up, making sure you're somebody that people think of when they need your services. So one of the things we've been trying to do and teach Seth here at the office is how to do that. Right? It's continue visibility, make sure we're somebody that people will always remember. So today, kind of wanted to jump into, we're new year, and there's a lot of I was reluctant to kind of go into this topic too much, just because it can get really in the weeds. And if you know me, you know that that's where I like to live, is in the weeds and getting into a lot of the numbers and the economic factors and stuff. And I don't know, I struggle with that, because I think that there's not many people that want to listen to that on a podcast. But nevertheless, here I am. I've had some encouragement for some people lately. It says, no, we do want to hear. We want to hear some, based off of the professional, what the market's doing, different things, right? So today I wanted to talk about just some strategies and based off of some real economic data, where the forecasts off and some predictions, right? We're obviously can't be 100% correct, but what we're seeing in the market, what we're forecasting to happen for 2026, and how to structure your investments in the best way possible to be able to generate some good success. So, like I said, really trying to dive into that, and there's a lot of factors usually when we look at the economy, different factors that we look at when we're factoring in real estate. We're looking at the job markets, we're looking at interest rates, we're looking at housing supply, we're looking at disposable income, we're looking at GDP. Lot of four-letter words, I guess, that a lot of people try to stay away from and don't want to hear. And it's weird, because we are in a time in history in our country where data is everywhere. But what data can you believe? Not even from federal sources and sources of power that should be telling the truth. There's not a lot of truth and a lot of transparency coming out. A lot of the information that's coming out is very skewed for political reasons, and it's tough to navigate, because a lot of people can fall into that, where you're not doing your own research. And it's one of the things that I just constantly preach to anybody that I talk to, is do your own research. Don't take it at face value. Don't take my word for it. Don't take information that just you hear somebody on the internet, on Facebook, Instagram, wherever it is. You're hearing some information, but you're not taking the time to follow up on their sources. Look where that data is coming from. The old dad joke that I like to say, that everybody has heard from me, is that 72% of all stats are made up, right? Again, that's a made up stat, right? We can say whatever, but if you put a number to it, you say percentage, as you say this, people tend to believe it, right? And it sounds truthful. To do your due diligence, take that extra step. Don't go to the top news sources that are out there and just take their word for it. Do the digging, pull up the actual reports. And that goes for a lot of different things that I think we don't do in society now. There's so much information that I think it creates a vacuum, and we kind of get stagnant based off of, you get frozen because there is too much data. But really look based off of your investment strategy, what you're looking to accomplish. And one of the things I always talk about, right, with everybody here, is what's your strategy? What are your goals? Everybody's strategy is different. What you're trying to accomplish is different than, Bob or Jim or whoever, right? So what factors are you looking for that are important to give you that successful outcome? So today I just want to give some information, some real world stats, some real world kind of approaches that I think would be good. Right now in 2026, all the forecasts, it point to continued contraction in our economy, continued contraction in our GDP. Right now, they're forecasting probably a growth of maybe 2%, if that, in our GDP. that's pretty slow. There's a lot of factors that have gone into it. Our labor market is, contrary to what you're hearing in a lot of sources, it's not doing good. There's a lot of unemployment. Our employment numbers are still too high. Um, it's one of the things that I struggle with a lot, because a lot of economists and the Fed and a lot of different places will tell you the way you combat inflation um, is by higher unemployment, right? And I understand that, right? Supply and demand. If you have less people with resources, disposable income to shop, that makes you lower the prices, right? So it's we're kind of hoping for the misfortune of others to be able to bring some prices down and the affordability index in check, and but and as much as you try to do that, right now our labor market is not, it's not growing. We're losing jobs monthly. We're not our, there's very few sectors that are seeing a lot of growth in that aspect, right? And then you throw on top of that all the tariff talk, and how that's impacting right now. The last numbers that I read was for 2025. I think the number was uh, the average household paid an extra $1,000 just in your regular monthly, I mean, just your regular expenses due to tariffs, right? And it may not seem like a lot, but somebody who's on a fixed income, somebody who's living paycheck to paycheck, that's huge, right? And that causes big changes. So we're seeing slow and soft labor market. We're seeing underemployment a lot, and that's a factor that not a lot of people talk about. Underemployment was, say, somebody who makes $100,000 a year, their jobs were eliminated or they were laid off. So that number, it was a positive number in the unemployment, right? It was a higher unemployment because it was somebody who was on receiving benefits. Um, but then they found a job, but maybe they took a job making half of what they were used to making. But now that tick goes off. Now they're not on the unemployment report anymore because they have a job, but doesn't mean they can afford their life, right? And they're underemployed, and that's a factor that we miss many times, right? And that's something that's, I think we're seeing a lot of, people who, were used to making um, more money, and because lack of availability, lack of good paying jobs, they're just because they need to pay minimal bills, they're taking a lower paying job, right? So that's one of the things that's happening. The housing market, right? They've been, it's been stagnant. The amount of listings and properties that are being sold are down, or they have been down all of 2025. A lot of that has to do with the interest rates, right? With the interest rates being, in the mid sixes, high sixes. In order for somebody to sell their property, that means they would have to go buy another property. And then that means getting rid of their 2.75, 3% interest rate to go buy, even if they wanted to move up, even if they have equity in their property, people are reluctant to sell, right? So that's why you saw a lot of people, some people buying another property, but keeping their original as a rental or doing things like that. So that's caused inventory to shrink, throughout 2025. 2026 forecast is, we're looking to, still hopeful. We're trying to see some little bit of a rate reduction, a little bit of rate cut. We're looking at maybe 25, 50 basis points. So that's a quarter to 0.5% rate. So we're still going to be in the sixes, maybe high fives if we're lucky in certain aspects. And here's, I'm going to do a little side note. People always talk about rates. Oh, my friend got a 5.5. My friend got this. My friend got that. Or my uncle, my this. One of the things that people understand is interest rates are not equal across the board. Interest rates have many factors. Your credit, value of your property, what type of property. Is it first-time home buyer? Are you living in the property? Is it an investment property? How much down payment do you have? How much equity is in the property? All those factors factor in. Is it an adjustable rate? Is it a 30-year fix? Is it interest-only payment? All those factors play into how your loan gets priced into an interest rate. So just when people talk about, but I saw, on bankrate.com, it's 5.75. Those are averages. Those are a skinny rate that sometimes not accounting for investment property, not accounting for lower credit score, not accounting for, not enough down payment, not 20% down. So just one of the things to kind of take into consideration when you're talking about that. But yeah, so we're forecasting a little bit of a decrease in interest rates. Maybe if interest rates come down, we're hoping a little bit of um, is that people who are on the fence about selling will start putting more properties on the market. Gives the buyers a little bit more flexibility, a little bit more control over in that negotiating process. Um, uh, there's I see both sides of it. I think there's people still on both sides of that fence and keep talking about, we're not going to see a whole lot of that. My fear, and I know a lot of other economists' fears are too, is if rates come down too fast, people that were on the fence will flood that market. Buyers, I mean, will flood the market, and then there become bidding wars on these properties, and then they will overpay and drive these prices even higher than they're supposed to be. Right. So that's my fear, and that's the fear of like I said, a lot of economists based off of if if and when rates, the Fed starts reducing rates, you can't do it fast, right? It has to be very measured and calculated. You will see if the political pressure does hit and they do drop those rates even by half a point or more all at once, you will see a shakeup in the marketplace that I think we're not prepared for. So just some of the things to kind of uh, be on the lookout, and when you're analyzing your deals, when you're underwriting your own deals, the federal deficit. It's noise, and we hear a lot of it, and a lot of people don't understand what to do with it. But it's affecting the capital markets. It's putting pressure on the rates, and it's putting pressure on how fast a lot of the bond market recovers to get people to get to for investors in the bond market to make their money back. It's getting, kind of things are all over the place. So it's just one of the things to kind of think about. I just had a conversation with my clients recently about this. Is going into 2026 strategies, look for cash flow. Look at items that are driving income. I see one of the things that I foresee in the next 2026, year and a half, maybe 2 years, is look for short opportunities where you can get in and get out pretty quickly, right? Uh, I think seeing some quick, look at different market drivers. Oh, the zoning is going to change in this market. There's a big infrastructure project being created in this area. It's going to drive this price up. Can I get in, hold it for a year and a half, 2 years while we get to that next from point A to point B, and then get out? Right. I think we're in a market where those type of opportunities will be good opportunities. Looking for those target markets where you're seeing something that doesn't necessarily isn't necessarily as obvious to anybody that's not an expert in that marketplace, right? And one of the things that I always preach is know your market, know the things that are happening. Is there a mall coming in? Is there an Amazon facility coming in? Is there hospitals, infrastructure projects? One of the biggest drivers in economic factors for a country and for society is infrastructure projects, right? And one of the things that a lot of governments will do, invest, right? And you may think, oh, why are they building this freeway? Why are they building train stations? Why, there's here in Los Angeles, we got the Olympics coming in, we got the World Cup, and you think, people can't afford their groceries, but why are we building these new stadiums? Why are we building a train? Why are we building these train stations? That's a very small-minded mentality. You have to look at a macro picture when you look at this stuff, right? Those are economic drivers. They're bringing jobs. They're bringing resources. They're bringing things, and that in itself stimulates the economy. If you got people making more money, people are employed, people are healthy, and they have a healthy stream of income. Sorry, what I was trying to say, they have a healthy stream of income, and they know that for the next 2 years they're on a contract where they're building this freeway overpass or whatever it is, sub plumbing, sewer systems, aqueducts. There's different things, and in different parts of the country it's different. And when you're seeing those infrastructures, projects, infrastructure projects, that brings an economic boom to those neighborhoods, right? So always take a look at that, right? Because that, usually for the most part, they're employing their surrounding neighborhoods. Those people have money. Now they're shopping. Now they're buying groceries. They're painting their house. They're remodeling. They're buying new cars. They're doing lots of things. So that is a big, so knowing your market, knowing what things are coming up, knowing what things, those opportunities, go to the city, find out what different things, go to your city council meetings, just listen, what projects are coming up, what are the things that can drive these property values to go up that maybe are being unnoticed, right? So do some digging, do some due diligence on that. And I think that's big. Not all markets move the same. Not all sectors, being able to differentiate between single family homes to condos to apartments to multifamily to even commercial properties. All of these markets and these segments work a little different. They move differently. In commercial space, we're seeing a big push for, a lot of the companies that were in work from home, which caused a lot of the Class A style office buildings to go down in value because they were being left empty for a long time post COVID. We're seeing a lot of the employers move back to a working in the office type environment, which starts bringing more drive and more demand on commercial space, which again causes these prices to go up. Right. One of the things that I told people, and I had some investors do it a few years back when they were seeing a depression in the commercial space, and a lot of people were very bearish, and they were kind of moving away from investments in the commercial space because seeing, hey, you know what, they're not cash flowing. Our market caps, our cap rates are very low because we're not seeing a lot of rentals, and our leasing is down, and we can't get it stabilized right now. So, but if you had the ability to stomach that and kind of outweather the storm, those a lot of those buildings are starting to do well, right? They bought the dip, they bought things when they were in a lower place, and being able to see kind of ride out that demand, right? So it's being an expert in your market, being an expert in what you do, being sensitive to the pricing, your rates, your what you're doing, your capital structure, how you're how you're capitalized, where your money's coming from. Is it coming from an IRA? Is it coming from your 401k? Is it coming from stock portfolio? Is your stocks outperforming the market? Do you want to sell stocks at a price to invest it into an asset that maybe isn't giving you that same return? Maybe, right? It's all about the total outlook of your portfolio, but being able to pinpoint that and look where is this coming from? Where's my capital coming from? Are you taking on debt? How much are you borrowing? What's the rates you're borrowing? What's the exit for that debt, right? Are you using other people's money? One of the things people talk about, OPM, use other people's money as much as you can, right? Stay liquid. Do you want to liquefy your positions and stay, invested here? It's all about how you want to structure your investment portfolio, and that's something that I think a lot of people don't factor in. And one of my last podcasts, we were talking about being that hustle mentality, that kind of hustler mentality, or a CEO, right? Approach things as a business, approach things as a CEO. How would a CEO, CFO, how would they approach this, right? They're looking at numbers. They're not going off of emotion. They're not going off of my gut. It tells me this. What makes sense for my portfolio? It's not a blanket statement, right? Sit down with people that know what they're talking about. Talk with us. We can help guide you. We can ask those questions that maybe you hadn't thought of, to how to diversify your portfolio, how to put things in different places. A lot of people, I can't tell you how many conversations I have with people where, JSS, we have an investment fund, JSS Capital, where you can invest money with us, fully approved by the Securities and Exchange Commission. We're fully licensed, have all the certificates, all the board, all the things that you would need to be registered as official investment vehicle, right? And we can offer certain amount of returns for your money, and we do outperform the majority of investment money market accounts. We can outperform most stock portfolios. We outperform 401ks. We outperform certificate of deposits. But yet people don't have that mindset. They're like, oh no, I have a 401k, and they're chugging along at 3.5%, 4% annual returns, and they think, well, this is it. This is what I have, and this is what I have open to me. Be open to look at different approaches, right? And sit down with people that can give you that expert advice on what things are out there, right? But going back into the 2026 and investment strategies, I think it's also an opportunity in this season, where we're looking at properties that have value add, that have opportunities to, put an ADU, look at your SB9 rules, look at, can I convert this to a multifamily? Can uh, I mean, there's lots of different things. If it's, is this property been abandoned? Is it vacant? Can we rent it out? Can we do this? Can we, look for diamonds in the rough where you can come in and add value to it. And then because of that, you're increasing the value of your property, not just waiting on the market to dictate what happens. Right. So I think that's a good thing. And like I said before, look for shorter term plays, look for opportunities where you can get in and get out pretty quickly, right? Where you're not so dependent on the long term focus on the market, because right now with the uncertainty and the way the rates are and the way the government is and the way a lot of different factors, growth, and there's a lot of things that are coming up that you're just like, I'm uncertain, what the 5 year outcome is. I can't, it's hard to forecast that far out right now. So maybe it is an opportunity to get in and get out, look at some things where you can, make quick exits. Obviously talk to your tax people about how quick exits affect your taxable income and all of those things, and that's a whole nother topic that we've talked about, is you're, doing this as a professional, having an LLC, having your opportunities so that you're limiting your tax exposure, right? So that's also different things to do. But really, it's manage your risk, know your data, know the factors that you're looking at, know what you want to accomplish, and what is going to drive those, right? What are you? One of the things I always talk about, it's in the term. It's what is being successful to you. How is this project on an individual basis going to signify a successful outcome? Are you looking to double your money? Are you looking to get a 10% return? Are you looking to have experience? What is it that you're looking with this particular project? And approach it that way. And then when you approach it that way, underwrite the file, underwrite the transaction to those parameters, right? It's not just because, hey, Bob said this is a great investment, so I'm going to go ahead and do it, right? Who does Bob know, right? Bob can be somebody who's, maybe he has a couple investment properties, but he doesn't really know much, right? And talk to professionals. This is the time where you can lean on people. Here at JSS, this is what we do. This is what we're passionate about. We're passionate about teaching people how to invest. We're teaching people how to invest in real estate, how to make structured decisions where you're putting your money to work, whether it's slow in a debt fund and you're just collecting an annual return, and letting us drive that for you, or looking to get your hands dirty and value add and fix things and elbow grease and do all that to drive your ROI. If we're going to help you, guide you to different markets where, hey, look, this sector right now is looking for an opportunity. Is it getting into retail, and what kind of anchor tenants you have in there, and being able to analyze a deal in that type of way. So that's what we are. That's who we are, and that's what we're here to do, and try to help you guys out. 2026 it's a year where I think there's a lot of uncertainty, as most years are. This being, I've been doing this 25 years, is one of the years that it's kind of hard to figure out. We wake up every day to something different. And all those things, believe it or not, in the macroeconomic sense, affect our economy, affect everything we do. One of the things that, that just, I don't like when people say, well, it doesn't really matter because, what's happening on that level and that scale doesn't affect me personally. It doesn't affect my day to day. It doesn't affect my things. And, I think that's a pretty ignorant statement to make, right? Because it does. Things that you think are out of your control really do affect what we do and how we pay taxes and how we invest. Kind of returns you're doing, your groceries and all those things. It plays a factor into what you do. So, just do your homework, be cognizant, be aware, do your research, right? Look at things. Look at the factors that you think are going to drive your market. And if you need help, talk to us. We're here. We're available all the time. Also, wanted to point out, we got some new little coffee cups in stock. Somebody wants one, drop a comment, let us know where we can send it, and we'll get you a little coffee cup. So, thank you guys for listening. Hope this was instructional and you got some good information. And feel free to follow us and reach out if you have any questions. Thank you.